All right, everyone. So we are recording topic 3 and 4 for accounting 315. So you guys did get a chance to review the video lectures for topic 3 and 4. So what did you guys think of that?
I suppose, well, in my case, I need memorize some things and also make a review for my before course of accounting.
Okay. So you had to review stuff from the earlier course?
Yes,
Oh,
theory.
okay.
Yeah.
That's good. That's good. What did the others think?
Yes, I need to, when I say I need to memorize, it's because, for example, I remember more topic 3 when I need to recognize where depreciation for current assets, that kind of stuff that when I have to consider one and other one. Yeah.
Okay. Okay, no, that's good. That's good. So that then we do have the stronger start, and it's really nice that you guys did review the slides. That way, it always the lecture recordings. That way, it always helps to put things in perspective. So just to do a quick recap of what topic 3 and 4 were, basically your topic 3 covers your statement of comprehensive income. So in that topic, we said that the companies do have two choices to either prepare two sets of financial statements, which is your statement of income and your statement of comprehensive income, or alternatively, they can combine these two together and make one statement. Okay. Then in that topic, we talked about the discontinued operation. So we'll talk a little bit more about that in just a minute here. Other than that, we talked about our multiple step income statement in that chapter as well. And then finally, towards the end, we had talked about the earnings per share calculation.
Guru,
Sorry?
sorry, I have another comment. I was doing a comparison between the book and the topic in the PowerPoint. So in this case, how can I recognize what is my charter in the book? Or is the same, is topic 3, charter 3?
No, no. And this
Oh,
is
okay,
something that we touched on last class. So you got
sorry.
to refer, no, that's okay.
Okay,
So the ICPs are referring to the same. So this, say, for example, this ICP, the in-class problem, the Excel files,
okay,
they have the same topic number reference. So once you open the file, these are the question numbers. So all of these questions, so topic 3 and 4, both of those were covered in chapter 4 because all of these questions are coming from chapter 4.
okay,
So
thanks.
P4 is the problem 4, E4 is exercise 4. So that's basically how you can gauge which chapter to refer to. I know it's a little bit complicated just by itself. So just look at the ICPs and you will see which chapter to refer to.
Okay, thank you.
No problem.
Does that mean that we're gonna come back to chapter 3, or it's just by default 3 and 4, this topic 3 and 4?
Well, chapter 3 will be covered in whichever topic it is covered.
Oh,
We are going to follow the topics. We are not following the actual flow of textbook layout. We are following what SAT's expectation of this course is.
oh, so what you mean is that we might not go back to chapter 3 in a later topic?
I don't recall it offhand, but we may or we may not. It really depends on what topics there are.
Oh, okay. So
Yeah.
I just wanted to confirm that, let's say for topic 3 and 4, where that's chapter 4, we need to read chapter 4 from the text for this topic only. That's what I...
That's right. Yeah.
Thank you.
And I'm just looking at, because you know what I did, guys, is there is that the course schedule that was, or the learning objectives that were posted.
Yeah.
Okay, the course assessment file that was posted online with all of the learning objectives. So I actually printed out my copy and I just wrote down which each of those chapters corresponds to. And that's the only way I could make sense of that. So maybe try doing something like that. But I totally relate to what you're saying. So yeah, there is no chapter 3 that I can see here.
Okay.
Yeah.
No need
All
to
right.
read chapter 3 in this case. Okay.
Sorry?
No need to read chapter 3 in this case.
Yeah, not for what we are doing. All right. Okay, so we were talking about the earnings per share calculation. So that was one ratio that we will be looking to calculate in topic 3. And then topic 4 was just a small little topic that talked about our statement of changes in equity. And under that method, we had talked about 2 different financial statements. One was the statement of changes in equity that will capture your adjustments from the prior periods and how to account for them, as well as your statement of retained earnings. Okay, so that basically was the gist of topic 3 and topic 4. So what we are planning to do today is look through all of these examples. So yeah, okay. So what do you guys remember about discontinued operations?
Is that it might be a project or something that a company would work on, but they're planning not to continue or to stop doing it.
I
Okay.
also remember that one should be related to the area, geographical area.
Okay.
Yeah.
And that business component is very independent operation, has that income and everything.
Perfect. Yes. Anything else, guys? So Kenny is asking, is it possible for you to share the Excel file for topic 1 and 2? For you guys, I have already posted all of that information on your, what do you call, D2L. So from the last chapter, everything is already there. This is something new we are trying in today's class. I'm just sharing my topic 3 and 4 file through Google Sheets. Okay, so I had, if you look at the chat above, there was a link that I sent. If you click on the link, you can actually pick up the same file that I'm looking at. Okay, but alternatively, guys, all of these in-class problem or these Excel files are already posted on your D2L right from the first topic up until the last one that we will do. So if you want to download it from there, then I'm good with that too, whatever works easiest for you. All right, one or the other. Okay, so any other thoughts on discontinued operations?
They have to be reported separately on the financial statements.
Why is that?
Just to give better information to potential investors, because if the discontinued operations made money, you don't want to lump it in with what their continuing operations are, because that could be misleading.
Exactly, because the user should be able to know what to expect in terms of ongoing items and items that are not are one-off. Any other thoughts, or we are good to move? Okay, so as you guys correctly pointed out, and I appreciate you guys listening to those video lessons, they always help. And you are right, when we are looking at the discontinued operation, there are certain criteria that has to be satisfied before we say that this is a discontinued operation. Okay, now it has to be a separate geographical location, or it has to be a separate entity, which is very self-sustaining in itself. Okay, they have their own assets, they have their own revenues, expenses, so it's pretty much a self-sustaining item, right? Now sometimes, and where that uh, understanding comes into play is to distinguish from sale of asset against the discontinued operation. So when the businesses sell their asset, they're just selling part of a business. Okay, they're not selling the whole independent unit. So that is where the difference is. So I'll give you an example there. So the business that I work for, so we are a mining company. So we mine silica sand. So a couple of years ago, we got into salt business. Okay, so during the winter months, you see those trucks that those grading salt that they put on the highways and stuff. So that is the salt that that's the business that we got into a couple of years ago, and we decided that it will be a good extension to what we do. So we came up with the business model. We picked up a location and we actually set up the whole operation from scratch. So in a year's time, we brought that idea to life and we went operational. We started making that salt for grading the highways. Okay. As soon as we went operational, the management decided that this was not in line with our long-term objective, because we are a mining company and we want to focus our resources and our energy on that particular segment, because that is where we see value and that's where we excel. All right. Salt business was great, but we decided that it wasn't in line with our long-term vision for the company. Nothing wrong with the business. Okay. Now that was the discontinued operation. The only reason that can happen is because the the whole processing unit, it was a separate geographical location. It had no bearing. It was very independent from our mining operation. So they were running concurrently. Our mining operation runs, by itself, had no bearing whether the salt plant was kept or was disposed of. Okay, so they were both very independent units and they were not linked to each other in any sense. Other than the fact that, we had some shared employees and the management was the same, but that doesn't matter. Right? The unit itself had its own asset, they had their own revenues, they had their own of their liabilities. So it was a very self-sustaining unit. That is why, because of all of that, it was classified as a held for sale or a discontinued operation. So when the management decides they don't want to continue in that segment or in that product or that geographical area, then that can become your discontinued operation. Before it becomes discontinued operation, though, the management has to look at these criteria, and all of these criteria have to be satisfied. It's not one or the other. Okay, the management needs to have a plan to sell all of their business. Okay, the changes to the plan should be very unlikely. The asking price for that business unit has to be reasonable. You can't be asking an outrageous price, right? Then you need to be actively looking for buyers. You need to have an active agent who is marketing your business, who is trying to find you a buyer, so on and so forth. So once all of these items are satisfied, okay, and the management does not intend to change their mind on this, the assets are ready to be sold as is, where is. So if all 6 of these criteria are satisfied, then we will classify this as a held for sale asset. So Kinshuk is asking, did you sell it to the potential buyer? Yes. Oh, so the example that I was giving you, yes, we did pull it out of that. Okay, so we got it all operational as soon as the management decided, and we went through all of these 6 steps to say, okay, the management is not going to change their mind. We started looking for buyers. The asking price was reasonable. We actually had a buyer, and that is what initiated all of that. The buyer approached us and we said, makes sense, we don't want to continue with this business. So it can play out in a lot of different ways, but yes, we did actually pull out of that. Okay, so that was my experience with the discontinued operations. So once the management decides that, yes, we don't want to do this anymore, okay, then as soon as that determination is made on that particular day, we will take the assets of that business and move it from the long-term assets section onto a category called as held for sale. Held for sale items are a current asset. Okay, remember, your long-term assets are depreciated, but your current assets are never depreciated. So now we take all of those long-term assets and move them into held for sale category, and that held for sale category is a current asset onto your balance sheet. Okay, and when I refer to balance sheet, guys, we got to recognize that it can be called as statement of financial position. Is everyone good with that, or do you want me to start calling it statement of financial position or SFP?
Income
It's okay.
statement.
So balance sheet is fine. Okay. Okay. So Debbie's asking, can the company ask for a lower price? Is that considered reasonable? Well, you'll have to look at your market, Debbie. Again, you know, bear in mind that the businesses don't do things out of the goodness of their heart, right? There is no charity. They want the best deal for their business. But at the same time, if they are pulling out of that market, they got to be mindful that what is the market I'm operating in and how many buyers are available. So there are a lot of factors that actually goes into that. Okay, just to backtrack that a little bit, in our instance, we were able to negotiate a decent price. We didn't have to mark down our assets, okay, because we were not pulling out of that market because there was no sales and we didn't want to. It was just that a buyer approached us because there was already a buyer who had dominance in that market, and as soon as we set up shop, now became two different suppliers out there. So he really didn't like that. Okay, so he approached us to say, okay, would you sell this to us? And that really initiated the whole process. And we said, okay, if we get a decent price, okay, and we built in our profit margins, we actually made good bucks on that deal, right? Because the transaction here was reverse, right? Somebody else was more desperate to buy. So it really depends on you know what your situation is. But either way, whether you get more or less for your assets, the idea of discontinued operation remains the same. Are you guys with me so far?
Yes.
Well, you could, well, and again, guys, you have to conceptually understand your concepts, okay? Just because in the slide it says that there is a loss on discontinued operation does not mean that there will always be a loss. I'm trying to focus on the idea that think of this logically. If there can be a loss, and that's why I'm giving you the example. Like in my case, we had a huge gain. We loved it, okay? So it doesn't have to be. That is just an example. If there can be a loss, there very well can be a gain as well. Point is, discontinued operation is something that the business doesn't want to do for whatever reason, okay? I just changed my mind. I just don't want to do. I don't feel like it. Whatever the reason is, don't care, okay? So that's what it is. So are we good there then?
Yeah.
So Makiko, for something to classify as a different or a discontinued operation, it has to be a standalone division, okay? If you're talking about a child company, which is practically a sister concern, that is a whole company. That is liquidation or sale of a whole company. We are not talking about that. Okay, this salt plant was one of our divisions that we set up under our existing Canadian company. It was a single company. One branch of the company is doing mining of silica sand, and the other branch of the company, there are two revenue streams basically, and the other division was doing the salt operation. Okay, so and that's a good question. So because you know you got to understand the structure of that, because if I have already set up two different companies, then we are not talking about discontinued operation, then we are talking about sale of a company, which is entirely different, and it will bring in different conversation. It's a very, very different place to be in. Okay, because if it's this whole company, then you're looking at goodwill and impairment and all of that fun stuff, entirely different conversation. So it's good to understand the structure. Anything else I can help with before we move on? No problem. All right, so seems like we can move ahead. And sorry, there are a lot of comments. I'm trying to keep up with them as I go and as I'm speaking. But if I miss anything accidentally, feel free to just, you know, nudge me so. Okay, so once we make the determination, okay, Ariana, you're ahead of me. We will get to all of that, okay? I'm still talking about this on a conceptual level. So once the determination is made that yes, it will be a discontinued operation and we want to sell this and we want to pull out of this market, then we will move these assets from long-term to current, okay? So once that is done, at that point in time, you might have to report two things. One is, okay, let's talk about this. So when you're designating your asset for HFS is held for sale assets. As soon as the assets move from long-term to HFS, we will stop depreciating on those assets because current assets are not depreciated. Okay. The other thing we got to do is, and generally we happen to do this at the year end. Okay. Because nobody's looking at the financial statements in the meantime. So we just do the journal entries at the year end. So at that point in time, we will look at the carrying value of our asset and we will compare that against the fair value minus cost to sell. So fair value is what am I able to sell this asset for? Let's say if I have to make some changes to the asset, or let's say the asset is mobile and I'll have to, transport this to a different location. So there must be some cost. Okay, even on a very simplistic term, if you have an agent engaged to sell that division, the agent is not free, right? They are going to cost you something. So that is your fair value minus cost to sell. So that net is compared against your carrying value. If your carrying value is high, then we don't make an adjustment. Okay, but if you're carrying, sorry, I should have said it the other way. Let's say your carrying value is high and your fair value minus cost to sell. This is what we are talking about. If your carrying value is higher than the net cost to sell, then we will have to bring your assets down. Okay, but if your carrying value is lower than the fair value minus cost to sell, which was our case, in that case, we will not recognize the loss, the gain here. Okay, it will come in later. Okay, because we are looking at remeasurement at lower of. If my carrying value is already lower, then I don't have to worry about it. Okay, and then we will move those assets to held for sale. At the year end, once the asset is written down, we can actually go back and at the time your asset is sold, okay, there are 2 points in this conversation. One is your year end and one is when the actual asset or that division is sold. At the time when you actually sell your assets or the division, the whole division, at that point in time, if you had any gain, then you can recover the losses that were booked up until that maximum loss is evaporated, but you cannot take over. Okay, and once we look at the numbers, it will make more sense. So let's bring this P4-2 into play and see what we are talking about. So P4-2, here we are. So on November the 1st, 2019, Campbell Corporation Management decided to discontinue operations of its Rocketeer division and approved a formal plan to dispose of the division. Campbell is a successful corporation with earnings of $150 million or more before tax for each of the past 5 years. The Rocketeer division, a major part of Campbell's operations, is being discontinued before it has, because it has not contributed to this profitable performance. The division's main assets are the land, building, and equipment used to manufacture engine components. The land, building, and equipment had a net book value of $42 million. That is the book value on November the 1st, 2019. So this is on the day when the management is agreeing that, yes, we want to pull out of this division or this market. Campbell's management has entered into negotiation for a cash sale of the division for $36 million, which is net of cost to sell. So fair value minus cost to sell is a net of $36 million in this case. The sale date and the final disposal date of the division is expected to be July the 1st, 2020. Campbell Corporation has fiscal year ending May the 31st. The result of the operations for the Rocketeer division for the 2019-2020 fiscal year and the estimated results for June 2020 are presented below. The before tax losses after October 31st, 2019 are calculated without depreciation on the building and equipment. So those are the losses that the business has incurred. Okay, now keep in mind, guys, when we talk about, just going back to the example that I was giving you with the salt division. So remember, I said that salt division was operational. Okay, we only sold it after it went operational. So it was actually generating revenues. Okay, so at that point in time, you look at your revenues and expenses. So when you're looking at these guys, these are the actual losses that the business incurred. So their expenses were higher than their revenue generated out of this division. So these are the actual losses coming from June the 1st to October 31st of 2019, and then from November 1st to May the 31st, 2020. Okay, so in that 1 year period, this is their total loss. And then the June 2020 loss is an estimate. So there are two pieces. One is to report on the actual income or loss of the discontinued operation. The other one is the loss on its asset value. All right. So Rocketeer division will be accounted for as the discontinued operation on Campbell's financial statement for the year ended May the 31st, 2020. Campbell's tax rate is 25% on operating income and all gains and losses. Campbell prepares financial statements in accordance with IFRS. So, explain how Rocketeer's division assets would be reported on Campbell Corporation's statement of financial position, which is your SFP or your balance sheet, as at May 31st, 2020. If they are calling it SFP, then they must be following IFRS. So how do you think they should classify or identify these assets on May 31st, 2020, which is their year end?
As held for sale,
As held for sale, and why is that?
because it's going to be moved from long-term asset to current asset in the balance sheet. Because they decided to sell it.
They decided to sell it, so we will move it from the long-term assets to the current assets. Good. Now, how much would you see that asset for on the books?
How much
36 million.
I'm sorry, do that again?
What was your question? Sorry.
So how much will the asset show up for? I think somebody was trying to speak there as well. They had the answer too.
36 million.
36 million. And why is that 36 million? Because the book value they said was 42 million.
No, but it says
It was a negotiated price.
yeah.
Use the lower
Net
one.
cost of net of the cost to sell was 36 million.
The lower of the book value, which is 42 million, and net fair value minus cost to sell. So we need to report our assets on the lower of those two numbers, right? So when we move these assets from the long-term asset section onto held for sale asset, the actual out of the long-term asset will be 42 million, and actually into held for sale category will be 36 million. The difference is your loss. Okay. Now, that is good. Oh God, I keep clicking on the wrong icon. Keep forgetting we are doing it differently. Before I get into why this looks a little bit differently, I'm going to, and I just dropped this tab just before the class. So in case you have, you're looking at the Excel on D2L, then that doesn't have this tab yet. I haven't done that yet. Okay, so this basically is what your income statement, this is a very generic layout for your income statement, just the big sections of that. The first section of your income statement or statement of comprehensive income is your operating section. How much money is the business making out of your operations, which is your revenues and your expenses, which the business incurs on a day-to-day basis. Once we know the operating piece, then the other big category is your other expenses, revenues, other gains, other losses. Now, what this encompasses is the other activities that are peripheral to our ongoing operations. So things that just happen around the business, such as the interest revenue. Okay, we haven't done much to gain that, but that's not our core business. It is just the money coming in. Okay, we lost some money on the, let's say, on the insurance claim. Okay, fine. It's not something that we do, but these activities are revolving around our business. So they become peripheral. So that is what your other expenses, revenue, gains, and losses are. Okay, and the reason why we are splitting it out in this kind of detail is because your user wants to know, what can I expect from this? Where is their money coming from, right? Just because their net income is a good number, it does not mean that it's okay, right? They need to know where that net income number is coming from. Let's say in our case, our net income was really solid in that case because we had gains up here from the dispositions and everything. But that doesn't mean I'm going to do disposition every day, right? So the users need to know, what can I expect on an ongoing basis from this business? Where is their money coming from? How are they making their money? Does that make sense? Feel free
Yes.
to use the chat function. Okay, thank you. Okay, so everyone is good till here. Okay, so that takes care of your operating. Now, when we are looking at our operating section, so on that operating section, we have to calculate our income tax on that piece. It is shown separately. Then we come to our discontinued operation. Now, discontinued operation is a one-off thing where we don't want to do this business anymore or run this division. Okay, by now we understand the concept of discontinued operation. So two sections of, or the two items that will show up in your discontinued operation is the gain or losses from the actual operations of that division, because remember, it is self-sustaining. It makes its own money, it spends its own money. Okay, so any revenues and losses that we had, okay, from that discontinued operation, because let's say if it's today on September 24th, we decide to classify this as held for sale. Now the sale is not happening for next 6 months, right? We are still looking for a buyer, but in the meantime, the business is operating. You're not shutting this down. So there will be two pieces. One is the income and loss from the ongoing operation. The second element it would be your loss on adjusting the value of your assets. Remember in that case, in the example that we were looking at P4-2, the book value was 42 million, but the fair value minus cost to sell is 36. Okay, so that's where those pieces will show up. But this discontinued operation piece, very important guys here, is that it's always shown net of tax. Okay, so we always take the tax effect out here. So all of that added up becomes your net income. And then if we have anything in the OCI section, then this will go down below. All right, so that's a generic layout, good to know. Now, how, in our case, how is this going to show up? So B, explain how the discontinued operations and pending sale of Rocketeer division would be reported on Campbell Corporation's income statement for the year ended May 31st, 2020. So that is our year end. What do you think? Two pieces here. One is the income or loss that we had from the actual operations. The second one is the impairment. Okay, impairment is the loss in the value of your asset. Okay, so I will break it down into two different sections, and then we can see how our financial statement is going to show up. So if I'm looking at my actual operations, they told us from June the 1st, 2019 to October 31st, 2019, we had a loss of $2.5 million. They also told us from November the 1st, 2019 to May 31st, 2020, we had a loss of 1.6 million. Okay, I haven't invented the numbers. They gave us all of that information. Where is my textbook? There. So that was given to us here. So I'm not inventing anything. I just brought the information forward. We also know that the income tax rate for the company is 25%. So here, our total loss in that 12-month period is 4.1 million. Okay, now if we have a loss, then the tax is a savings. We don't have to pay tax on that. So 25% tax savings on this works out to be 1,025,000. So that means our net tax, net loss after tax is only 3,075,000. So operating law, the discontinued operations loss minus the tax that we are saving. Good so far?
Question, please.
Mm-hmm.
Why the applicable tax is positive? Why not a deduction?
Because it's a loss. Okay, we only pay income tax when it's a gain. If it's a loss, then we have something called as income tax recovery. So it's savings. You don't have to pay tax on those. So losses and gains, you know, they all get the same treatment for the taxes. That's why. So if you had an income, your income, the tax will be a negative number. Okay, if you have a loss, your tax will be opposite. So they always are opposite.
So what does it mean, this positive number?
It means that it's savings. So our total loss is only the net difference.
Wow.
If it was an income, then you would have to pay tax on that. Okay, if it's a loss, then we save the tax on that. That is how the tax works.
Okay.
All right. So that is your $3,075,000 of loss from the ongoing operations, okay, on our financial statement date. The second piece we need to look at is, did I have impairment on my asset? And in this case, you guys said that yes, we did have impairment because our book value of the asset was $42 million. The fair value minus the cost to sell is my $36 million. That means my asset practically is impaired by $6 million, which is the difference. Now, again, if it's a loss, then taxes are a saving. Okay, so there is a provision to claw back. So if my loss was $6 million and I ended up saving $1.5 million of taxes, then technically our after tax impairment loss is only 4.5 million. That is right, Ariana. Loss is negative, tax is positive. They will always have opposite effect. Does these two pieces make sense? So what we are going to do then is present these on our financial statement. So what they will look like is this. Okay, now remember I showed you the actual format. Oops, how do I, that's weird. Okay. So this is just the partial presentation because we don't have enough information for the continuing operations piece. Okay, but you got to recognize that that is where your financial statement is. Your discontinued operation always comes after your continuing operation. And you have to, on the exam, if this shows up, you are expected to show this line even though we don't know the number. Okay, because that tells us that we understand the discontinued operation will come after your continuing operation, which is critical. This piece can never come before the ongoing operations. All right, so once we have established that, then we are going to explain our discontinued operations. Now, again, there are two pieces to the discontinued operations. One is the actual gain or loss out of the operations, which is this $3,075,000 net of tax. So here the divisions, less applicable income tax recovery. Okay, so that is your loss from operations. So from the ongoing operations, the business has lost $3,075,000 on that side. And then the business is adjusting or has an impairment loss on its asset that were written down. Net of tax, so the tax on that was 1.5 million. So the net of tax, the number is 4.5 million. No, Kinshuk, that is not true, because remember here we said our income tax is calculated separately. Okay, so there will be a line here for your total operating income before taxes, then comes your income tax. So operating section is treated differently than discontinued operation. And that is where that difference lies. Here, we will have to report them net of tax. Okay, because tax has already been adjusted up there. You need to have some consistency here, guys. We have already accounted for our tax on the operating piece here. That means we cannot muddy the water going forward. It has to follow the same format so that people can make sense of this. So here, once the income tax is already calculated, then anything going forward, it will just be net of tax. Is this good?
Teacher,
Yeah.
All right.
it's not clear for me. Hello? I have a question, please.
Okay.
Yeah, it was the same question like what I have asked before. When it is loss, we added the applicable tax 25%. I don't know what is the logic behind that. Why don't you leave it like that, the loss? If you don't deduct tax, we can leave the way it is, but we add the applicable tax. So what's the
Well,
logic
that
behind
is
that?
the tax rule. So really there is, logically, if you make income, we pay tax. If there is
Yeah.
a loss, then they give us the same equation on the other side. That means we can recover the taxes that were paid. That is how income tax rules work. So it's nothing that the business has done. This is one of the critical pieces of the income tax. So if or when you guys do take the income tax course, they will talk more about this there. But if we had income, we pay tax. If we have loss, then we get to recover. Just stick to that, and that is that.
Okay.
All right. Okay. So we are going to keep going there. So then for part C, on July the 5th, 2020, Campbell Corporation disposes of the division's asset at an adjusted price of 40 million. Okay, now this is, remember guys, we prepared our financial statement for May the 31st, 2020. Okay, we were expecting the sale on July the 1st, and in reality, the sale happened on July the 5th of 2020, which is fine. At that point in time, we sold the asset for 40 million. All right. Now, if you think of this, how is this going to be reported on the next financial statement, which is on May the 31st, 2021? Okay. Now, if you think of your financial statement, look at your prior financial statement. So this was our prior financial statement where we said we were expecting this asset to be sold for $36 million net. Okay, so we took the impairment loss of $6 million after tax, which came out to be 4.5 million. But when we actually sold that asset, we ended up getting a better deal. That means we recovered some of this loss. Okay, so we are going to see how this is going to look. So we are going to do the same two pieces that we did earlier. So first of all, we are going to calculate the income or loss. So from June the 1st to June the 30th, that is the time when it was operational. We estimated a loss of 300,000 and they said it was the same. So if it's a loss, once again, we will save tax of 25% on this. So our after-tax loss is only $225,000. That is from the operating or operations of that discontinued operation because it was still working up until we sold it. Okay, so that takes care of one of those pieces, which is what really you are seeing here. When your loss from operations of that division is represented net of tax, it's 225,000. Now coming back to the impairment, okay? Now we had at your prior year end, we moved our asset from 42 million down to 36 million because that was our estimate for selling at the time. So right now your books are sitting at $36 million of asset. Okay, so your net book value is 36 million. because we had booked the loss in the prior period. But our adjusted price at the time of sale is 40 million, which means we actually ended up with a gain of $4 million. So now we are able to recover that gain out of this impairment loss that we had written off, but it can never be more than this one. Okay? It won't be the impairment gain, it will be the other gain. So here we are able to recover $4 million of impairment loss that was booked. Now, if it's a gain, then we will have to pay tax on that. So it's always opposite. So our gain net of tax on disposal is 3 million. So when we are representing our financial statement, we are still starting with our continuing operations. So there is a line for that. Then we talk about our gain or loss from the actual operations, which in this case was a loss of 225,000. But we had gain on disposal of Rocketeer division of $3 million. So that will give us the net for your discontinued operations, and your net income will be the combination of your continuing operation as well as your discontinued operation. Any questions?
If it was sold at the same amount and there was no gain, which is
No, it's not sold at the same amount. You estimated to sell it at 36 million. You sold it for 40 million. So it's not the same amount.
Yeah, I know, but I mean if.
Oh, if they actually did sell it at 36 million as estimated?
Yeah.
Well, then you wouldn't have this line.
Okay.
Because then there is nothing, then this one wouldn't be there.
Sounds good.
Right? If it's zero, then no point in reporting that. But that is a very rare thing.
Yeah. Okay.
Mm-hmm.
So if they've already sent it at 36 million, so I don't believe that June 1 to 31 estimated loss will also occur.
No, that's an actual number. It's not estimated at this point in time because the question told you. Okay, it was estimated when they started, but then somewhere they said Campbell's tax rate and operating income. No, where did they say that? Okay, assume that June's 2020 operating loss is the same as estimated. So this was estimated at that point in time, but now it became actual.
Okay. No,
Yeah.
no, my question is like, if they have, if they could have sold the business, at 36 million, if they, if it was sold before, then I don't believe there would be estimated liability, which would be coming like $300,000.
No, you're talking about two different things. There is no liability here. That is the gain or loss. And that is where we need to be able to distinguish the item that we are looking at. So this 300,000 is not a liability. Liability is an entirely different item. We haven't talked anything about a liability here, okay? This is the gain or loss. But again, based on the question, it was estimated to sell a month after your year end. And these are the estimates. The market could crash and this actually could end up getting stretched for another year, right? So reality is always different than what we are estimating. The question is, how do we account for that difference? So conceptually, it doesn't change. Okay?
Yeah.
Yep.
All right. Any other questions before we move on? Because we got a couple of questions to go through and we've almost spent a good 50 minutes on the first one. Okay, so let's go to, I'm just going to make sure I have everything listed here. Okay, so we'll go to E4-13. E4-13. There. Okay, so here we are preparing a multiple step income statement for with unusual items. Now, when it comes to income statement, guys, you are or you will be examined on multiple step income statement only. At this point in time, it is an intermediate course. I really don't care whether you can prepare a single step or not, because that is really, really basic. So when the exam is asking you for a multiple step income statement, it means multiple step. If the students end up making a single step income statement, then they are not getting any part marks. Even if you have your sales number correct, there are no part marks because it's entirely two different things. All right. So we are going to prepare our multiple step income statement. Now with the multiple step income statement, does anyone remember what we said in the notes there in the video recording? What is the generic structure? What should it look like? Nah, okay, let me show you.
It should have operating section and non-operating section.
Okay, so it should have operating and non-operating section. Perfect, so that's a good start. So our top half should be the operating section and our bottom half should be our non-operating section. Amongst the operating section as well, guys, so there is sales, sales minus cost of goods sold. And I usually, you know, when I was a student, this is how I always made sense of my world, just to have some sort of a structure. So I always like to work with skeletons. Okay, so if I know that I'm going to be making a multiple step income statement, then the first thing I'm going to do is put a title, name of the business, name of the financial statement, and the period it's representing. Okay, once I have that, then for the multiple step, I need to have a sales revenue section that will explain the details, and we'll talk a little bit more about that in a bit. But sales minus your cost of goods sold is going to give me my gross profit. From that gross profit, because we are talking about purely the operating section right now, I need to deduct my operating expenses. Your operating expenses are also called as your period cost in managerial accounting world. So these are your selling expenses and administrative expenses or depreciation, those kind of items that you need to incur in order to run your business. So they become part of your operating expense. So gross profit minus your operating expenses is going to give you income from operations. Okay, so now this is my operating piece. Now somebody correctly pointed out that I need to have, can I please request you to mute yourself? Okay, thank you. So that is your operating section. Now we will move on to the non-operating section, and non-operating was things that happens around our business. Okay, intentionally, unintentionally, these are the things surrounding us, which is where we will talk about other revenues and gains, other expenses and losses. And once we have all of that, then that will be our total income in this case. So a couple of different ways of presenting that. Okay. Okay, and that should finally give you your net income. So this is a generic layout. Okay, sales minus COGS gives you gross profit. From that, we deduct our operating expenses to know what money came from our actual operations. Then we talk about our non-operating items, other revenues, other gains, other expenses, other losses. We'll bring all of them here. And the net difference is your net income. Now, when it comes to your sales revenue, we need to express our sales revenue in the gross amount, but also adjust for the contra accounts. Does anyone remember what is a contra account? I'm pretty sure we talked about that. And I did give you a fun thing to remember it by too.
Yeah, you did mention that your kids, they are your
The kids, yeah.
That's depleting.
Just for the record, I love them. Yeah, I know. In fact, you know what? My oldest kid turned 13 this week. So we are kind of really excited about having a teen in the house. So I know. Okay, so that is your contra account. So the contra account, the whole purpose of your contra account is to deplete the earnings of the parent account that they're attached to. All right. So your sales is the actual parent account, so to speak, you know, just to understand. And your contras is your sales returns and an allowance and sales discount. The contra accounts will always have opposite effect to the main account that they are attached to. So the difference in all of those three accounts will give you your net sales. All right. So let's get on with our example and see what we can do. Okay, so bunch of information stated here. Always keep in mind what is the information presented and what are we doing with that, okay? They are two different pieces. What you are doing is what will dictate the information we need to use. So in this case, we are looking at multiple step income statement, okay? So not all of the accounts that are presented in the information will always be relevant. But at the same time, you got to analyze each account and say, do I need this? Yes or no? And if I don't need this, why do I not need this? You want to go through that thinking process when you're practicing these problems so that you can solidify your understanding of concepts to say, you know, why am I doing this? Accounting is really fun if you can understand the logic behind those numbers and information. You know, I love accounting because I see the logic behind that. Okay, people who don't see the logic behind of how that information is flowing, I can see why this can be a very daunting process. So different ways of looking at that. Okay, so look at your information and say, do I need this? If the answer is no, why don't I need to use it? Okay, what's my reasoning? That will help you understand it better. If I do need to use it, then where do I take this? So go through that thinking process. It will take you a little bit longer, but will make your life easier on the exam. So I'm going to read through the accounts. You guys quickly got to give me a yes or no. And, you know, let's make sure that we give chance to everyone. Okay, so interest income. Would we need this account?
Yes. Yes.
Why?
Yes. Because it's a revenue.
Because it is revenue account. Perfect. Okay. Cash.
No.
Why not?
It's a balance sheet. It's a permanent account and it should be into a balance sheet.
It's a balance sheet or statement of financial position account. We are not doing one, so we don't care. Sales revenue.
Yes.
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 No. Yes. Sorry.
Okay, and let's make sure that we give an opportunity to everyone else to speak as well, please. Accounts receivable.
No, it's not become to the income statement.
Thank you. Perfect. Prepaid insurance.
No.
Yes.
No.
Yes.
Oh, somebody said
Yes.
yes and somebody said no. Okay, so the person who said no, why did you say no?
It's in a balance sheet.
It's a balance sheet account. And the person who said yes, why do you think it should?
Yeah, I believe it's an expense.
Prepaid insurance are basically.
It doesn't say expense.
It's an
It is a
asset.
prepaid
It's an asset,
insurance.
yeah.
It's an asset account. It's a current asset on your balance sheet. Okay. And this is where this process will help you solidify, because if you're wrong, then you would eventually know that you're wrong. And then you'll go, this is why I am wrong, right? So sales return and allowance.
Yes.
That,
Yes.
sorry. Yes,
Yes.
because
Yes.
It's contra asset
Contra
to
to sales.
it's the
sales.
contra to sales account. Perfect. Thank you. Sales discount.
Contra.
Yes.
Yes. Yes.
It's a contra to your sales
Sales.
account. So yes. Land, equipment, building.
No.
No.
Balance sheet.
No.
Yes.
I guess
And
you
why
get
is that? Hold on. Why is that a no part? Do you have a speaker part?
because
Because it's a balance sheet
balance
account.
sheet
That's why.
account, yeah.
Okay, perfect. Thank you. So cost of goods sold.
Yes.
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 Yes, because remember there was a special section for this guy. So yes. Accumulated depreciation for equipment and building.
No.
No.
Why
Balance sheet.
not?
It's in the balance sheet.
It's a balance sheet. Okay, so where would this go on the balance sheet?
Asset.
Yes,
Contra asset
from
of issues.
deducted from
Under
asset.
Perfect. It's a
Under the asset.
contra asset to these asset accounts. So equipment and building will have these babies attached to those. So those are your contra accounts. Awesome work, guys. Notes receivable.
No.
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 Where would it go?
asset.
It's an
Yes,
asset.
Balance sheet. Balance
Exactly.
sheet.
Balance sheet.
Asset as a balance sheet. Awesome. Selling expense?
Yes.
Yes.
Yes, because it's
It's an
expense.
expenses. Yeah.
Okay. Accounts payable?
No.
No,
No.
it's liability.
Balance sheet.
Okay. Bonds payable?
No.
No.
Balance sheet.
No, that is also a balance sheet. And I'm starting to hear the same voices. So can I
Yeah.
hear a new voice, please? Okay, you ladies go on a mute and let me see who else is here. So bonds payable, we said no. How about administrative expense?
Yes.
Yes.
Go ahead, Kenny.
Yes.
Okay, yes.
Yes.
And that is because, where would it go?
Expense, operating expense.
Thank you. That's
statement.
right. Mm-hmm. That's awesome. Unearned revenue.
That's a liability, right?
Yeah, yeah,
It's a liability. Okay, so onto the balance sheet then?
Yep.
All right. Interest expense.
Income statement, yes, because it's expense.
Yeah.
Income statement because it's an expense. And where would this go?
Operating.
Other.
Sorry? Sorry, there is someone talking in distance, but I can't hear clearly. What's that?
I mean, non-operating expense.
Non-operating, yes. So it will go into the non-operating section. Perfect. Notes payable is a liability, so we won't worry about that. Loss from storm damage.
The same. I think this one also non-operating expense. I think. I don't know.
Yes, we will need this.
Losses are not expense, guys. So at this point in time, as soon as you guys get to the intermediate level, you have to be really careful with the jargon that you use, because if I call my kid something else, they would be awfully upset, right? So that's because they all have different characteristics. They mean something. Right? So same thing goes for the accounts as well. These accounts mean something in accounting world. Losses are treated way different than any expense. Gains are treated very differently than revenue. So they are not the same items, which means we cannot use the names interchangeably either. Okay, so I know we're just getting started and I might be being a little bit harsh, but try to use the right terminology. So this is the loss, and it, as correctly somebody pointed out, it will be part of the non-operating section. Okay, and depreciation expense. So this is an expense, so it will go to income statement. So my question is, and this is the last one for this question, and I want to hear a new voice here, is where would this go?
Under operating expenses.
Under operating expenses. And how did you figure that out? Did you know that, or did you memorize it, or did you just figure it out somehow?
I think I memorized it.
You memorized it? Okay.
Yeah.
That's fair, and nothing wrong with it if that works, but is there a logic behind that? I mean, why? If I
It's
didn't know,
definitely
and
must be, yeah.
Yeah,
Well, asset is something that help us to generate the revenue, and depreciation expense is because we're depreciating assets.
Exactly.
Something that helps us
Because
to
of the matching
generate.
principle, we need to depreciate the asset.
bingo.
Yeah.
That is perfect, guys. I'm impressed. That's perfect, and that's exactly what it is. Okay, because the assets are helping you generate revenue. So remember those depreciation expense as per the matching principle. We try to match our expenses with our revenue, so this become part of operating. So once you go through all this ordeal of figuring out where it goes and if it doesn't go anywhere, then we will start plugging them in, which is a really easy task. And they told us that our effective interest rate is 25%. So I spend most of the time in analyzing the accounts to say whether or not I should bring them to my financial. And with the financial statement, okay, as soon as we know that this is the format we are following, or this is a multiple step, you will always be examined on multiple step at this time. Okay, so this is my format. All I got to do now is just bring my numbers here. Nothing fancy. Okay. I don't use Google Sheets very often, so I guess I'm having a little bit of a ability issue here. There. Take a look and see if that makes sense. So sales minus the contra account for sales revenue and sales returns and allowance and sales discount gives us the net sales of 962,000. Out of that, we deduct our cost of goods sold, so that's our gross profit of $458,000. Out of that $458,000, you are deducting all of your operating expenses, which is selling and admin plus the depreciation expense, to recognize your income from operations. Out of that income from operations, if there are any revenues and gains, then those are added. Okay, and this is something that you guys got to remember, because we don't like to show negative numbers on our financial statements. Okay, some companies do, but mostly it's not a common, it's not a norm. Okay, so here we have shown them as absolute numbers. So that 168,000 plus 70,000, which is your revenues and gains, minus your interest expense, minus loss from storm damage, gives you your income before income tax. And then I don't know why I don't have income tax here. Ta-da! So income tax expense of 5%, which is $16,000. That means our remaining net income is only $48,000. Any questions here, guys?
So the part for non-operating expenses starts with interest expense then?
Non-operating? Yeah. No, no. Non-operating starts from here.
Oh, okay. You
Okay.
don't have to like mark it in a income statement? Like saying like here you said like on the line 14, it says operating expenses, and you don't have to put another line? No? Okay.
Nah, we just, I technically don't even like this. Personally speaking, I don't like this. The textbook does it this way, so I didn't want you guys to be overly concerned that I was doing things in a different manner. But I actually like to get rid of this thing completely. What did I do? I don't like to deal with that, so delete row 22 and 23. Okay, so this is what I like to do. So 168 plus that minus that minus that. And then my income tax expense was 25%, was it? And there. Okay, this is my preference because it really does not matter at this point in time whether we make two different sections for revenues and gains and expenses and losses. I usually combine all of them together. Do that to be safe. Then that way, this is the entire section is non-operating. And how do I take out these lines? Okay, let's try this guy. Awesome. And income. There, that's better. That's right, Kinshuk. If you had discontinued operations, then remember with the earlier example, we said we are going to look at income from continuing operation first. Okay, so that is pretty much this. So operating and non-operating expenses pretty much goes, and then here the discontinued operation will come below that. And then finally, because you've already calculated the income tax here, then with the discontinued operation will reflect them net of tax. Any other questions here, guys? The one last thing that we have to look at here is the EPS calculations. Now we are preparing that multiple step income statement that we did, but the question is also saying, assume that 150,000 common shares were outstanding during the year. Quality Fabrication Limited follows ASPE. but decides to disclose EPS on its income statement. Now, the companies that follow IFRS have to show this earnings per share calculations on their financial statement. And this ratio is really one of the most important ones. Okay, not to say that the others are useless, but this is a special guy that gets treated so special because this is the only financial ratio that is represented on the face of your financial statements. All the other ratios that we have, and we have about good 16 to 20 ratios that we use, okay? All of those are usually used in the back end to analyze information. But this guy is the only one who actually makes to the face of the financial statement. So really important and special guy. Okay, so earnings per share, quickly guys, this is the formula. The common shareholders look at this ratio to see how much money was made by every common share that was outstanding. So the formula is net income minus preferred share dividend divided by weighted average common shares that are outstanding. We also call that as VASO. Okay, in a bit we will look at how to calculate VASO. Okay, but for now we already know what our net income is, which is $48,000. Now, how much are we going to pay to our preferred guys? Okay, this ratio is purely for common shareholders. That's why they want to take the preferred shares, preferred guys out, because remember, preferred guys don't have voting rights. Only thing that common shares get is the voting right. They don't get any other preferential treatment. On the other hand, your preferred guys could get preferential treatment depending on the class of shares. Okay, there is a whole topic that discusses that. All right, so here the EPS ratio is purely for the common shareholders. So the common shareholders want to make sure that they bump out these preferred share guys out and their dividend out to say how much money was made for each common share that was outstanding. Logically speaking, do you want this number to be high or low? Let's say you are the common shareholder. Do you want your common share to make high income or low income?
Hi.
For common share.
Hi.
Hi.
Hi, of course.
Makes logical sense, right? So we don't have to memorize anything. We want this number to be high, and higher the number, the better it is. All right. So here, the question did not discuss anything about the preferred shares. That means there are no preferred shares. So our net income of $48,000 minus our preferred share dividend, which in this case was 0 because they didn't say anything, divided by the weighted average shares that were outstanding. And in this case, the guys were really nice. They told us we had 150,000 shares outstanding. So we will just use that. So if I take 48,000 divided by 150,000, I get 32 cents. So each common share that is outstanding in the market earned 32 cents of this income. Doesn't mean they're getting paid. Okay, so don't confuse yourself. Nobody's getting paid here. This is more like a feel-good factor. Okay, so we want to feel the best that we can. And then this is what's disclosed onto the face of your financial statement. For IFRS companies, guys, this is a requirement. They have to show earnings per share. Okay, now ASPE companies have a choice whether they want to show it or not. In our example, the company is ASPE, but they chose to show it so they can, but they don't have to. It's their call. Okay, now since we are talking about earnings per share, if the earnings per share is shown on for the IFRS companies, they always have to. It's not a choice. Okay, so if the company has discontinued operations, then they will have 3 line items for these guys. One is earnings per share from continuing operations. Second, earnings per share from discontinued operations. And third, earnings per share, which is the net. With me? Goody good?
The net is the difference?
Mm-hmm.
Okay.
Yeah, addition or difference, whatever it is. It could be higher, it could be lower.
Mm-hmm.
I have a question here.
Okay, sorry, before you have that question, I think I might have misspoken there. Earlier, somebody asked about the discontinued operation. Sorry, the discontinued operation will come before this line. My apologies. I think I said after this line, so I take that back. It will come before, because net income is the final number. Yes, yes. So we will throw a subtotal for these guys here, then talk about our discontinued operation, Kinshuk. Then the total of our operations plus the non-operating activities and discontinued becomes your net income. My apologies, I confused you guys. Yeah, okay. Sorry, somebody had a question there.
Yes. Why do we need to calculate the discontinued operation per share?
Because the users need to know. That is, see, some of these things is not up to the company. Okay, this is what the accounting standards are going to require us to do. So from the user's perspective, the most logical explanation here is that your user needs to know how much money is actually made per common share from the actual ongoing operations. Because really, when the user is looking at it, they are counting on the continuing operation, right? Because that is what the business does. Discontinued operation is a
Yes.
one-off thing. So even if my net income, the bottom line, remember there were three line items. There is one example that will talk about that. So even if my net is lower, my user still should be able to go back and say, ah, that makes sense. It's lower because these guys had discontinued operation. I believe in the business and I know they don't do this. So if they made a decision to pull out of this, then there must be a good reason. So it's okay. I can live with a lower EPS on net income because I know that what's coming from their operations is a strong number. So it's a full disclosure and the users can make those kind of deductions.
So for the net for EPS, we need to subtract so we
We
need to
will look
take.
at an example and it will make more sense there. Maybe I spoke earlier, so let's wait for the example and it will make sense there. Let's see if it's here actually. 4-18, is it here? Yes, it is here. So let's jump into this one and that probably will make more sense. 4-18. Do you guys need a quick 5-minute stretch break or are you doing good? Since we have that hot topic and we want to get through that, or please feel free to type, let me know. Short break, short break. Okay. Okay, so let's take that 5 minutes break. It's about 7:19 now. So we'll be back at around 7:25 or 24-ish and then get started. Okay, so I'm just going to pause the recording here. And then we'll jump into E4-18. E4-18. Oh, it's right here. Okay, so earnings per share. Okay, at December 31st, 2020, Tres Hombres Corporation had following shares outstanding. 10% cumulative preferred shares. They have a total of 107,500 shares. So these are the number of shares that are outstanding. And these shares brought in a share capital of $10,750,000. Common shares, we have got 4 million shares that are outstanding. And they brought in $20 million. All right. Now, during 2020, the corporation's only share transactions with the issuance of 400,000 common shares on April the 1st. And during 2020, the following also occurred. They have income from continuing operations before tax of $23,650,000. Discontinued operation was a loss before tax of $3,225,000. We have preferred dividend declared, common dividend declared, and the effective tax rate of 30%. So we are calculating earnings per share as it should appear on financial statement of Tres Hombres Corporation at the year ended December 31st, 2020. So here it's sneaky. Okay, they're asking you to calculate EPS, but what they're not telling you is that if the business does have operating and discontinued operations, then they have to show 3 lines for EPS calculations. One, which is your EPS from continuing operation, other one for discontinued operation, and third one, which is your net income. Okay, so let's look at our calculations. Now, in this case, in order for us to, let's see, what approach do I want to take? So let's do the, let's calculate our net income first. Okay, so here they are telling you that the income from continuing operations is $23,650,000 before tax. So if you remember our structural layout, we said we will have the income from continuing operations before tax. Then we calculate our income tax, and that becomes your income from operations. So the same idea applies there. The discontinued operation loss before tax is $3,225,000. But we said that when it comes to the discontinued portion, we always want to make sure that the information is presented net of tax. So this is what it looks like. I haven't done anything fancy, and this is just the calculation so that we can look at the EPS. That's why I'm showing the discontinued operation a little differently than what you guys have seen so far. Okay, so all I did was my net income from continuing operations is $23,650,000, which is before tax. We know that the applied tax rate is 30%, which means $7,095,000 of my continuing operating income will have a tax. So my income from continuing operation is $16,555,000. So up until this point, nothing has changed. Your financial statement representation actually is the same up until this point. Okay, it slightly differs when we talk about the discontinued operation, right? Here, up until this point, we have shown a net of tax number, and even here we are showing the same thing, but we are showing 2 line items, which is a not very common thing. Okay, so our loss before tax was $3,225,000. And our income tax is still 30%. So we said if we have a loss, then we don't have to pay income tax, but we do get to recover it. Okay, so that is what Kenny and I were talking before we started recording. So we get to recover any income tax on the losses. So that means my loss is just the difference, which is $2,257,500, which is the difference between my loss before tax minus the income tax that I will recover either from past periods or in the future periods. So if I add up my operating income of $16,555,000 and my loss from, sorry, not the add up, but take the difference because it's a loss from the discontinued operation in this case, my net income is the difference in those two, $14,297,500. Okay, now we need 2 pieces to calculate our EPS. One is the net income, which is this. Okay, now that net income, remember, if the business has operating and discontinued operations, then you need 3 pieces of EPS calculations. The business has to show 3 EPS calculations, 1 for continuing operation, 1 for discontinued operation, and 1 for net income. Are we good so far?
Yeah.
Okay. Perfect. Okay, so in order for us to calculate that, we have already done part of the work to calculate what our income from operations, income from discontinued operations, and what's our net income. So one piece of our calculation is done. Now, this information here, guys, was given to us. So I'm not pulling anything out of a hat here. This was stated in your question. I just brought it forward. So 10% cumulative preferred share, these are the number of shares and the share capital. Same thing with your common shares. I just brought the information forward. I haven't changed anything. I haven't invented anything. I haven't calculated anything. Okay. Now, if you think of your earnings per share need net income, which is what we calculated here. But it also says net income minus preferred shares dividend. So what I'm going to do here is calculate what that preferred share dividend is. Any thoughts on what it should be? I'm looking for a total dollar value. How much dividend should be given to preferred shares? Do we know or we don't know? Whatever.
Is it a 10%?
10% of what?
10,750,000.
Okay, if I'm looking for a dollar value, it only makes sense to take 10% off the total dollar value. Okay, and again, guys, you know what, accounting is so logical. Just try to find the logic behind the information and life will be such a beautiful place. Okay, so preferred share dividend entitlement here is 10%. 10% of what? Well, 10% of my dollar value, not the number of shares. All right, that's not going to give me anything. So $10,750,000 times 10% means that the preferred share entitlement is $1,075,000. Okay, so now we are making progress. We are halfway done. We needed 3 things. Net income, which we did, done. Preferred share dividend, done. All we need is weighted average shares outstanding, and then we can jump into our calculations. Now, weighted average shares outstanding, there are different ways to calculate this. Okay, this is my way and I love it just because I do it. The textbook often follows a very different approach. There is nothing wrong with one or the other. I think my approach is more logical. But so what I'm trying to get at is I'm not trying to sell you my approach. All I'm trying to say is just either stick to mine or stick to what the textbook does. Don't try to make sense of both because that is not worth your time. You'll end up confusing yourself. Okay, so just pick with one and stick with one. All right, whatever works for you. So coming back to our question there. So they said common shares, and the VASO calculation, guys, is strictly for common shares outstanding. And I did say that in the formula in case you haven't noticed that. So weighted average common shares outstanding is VASO. Has nothing to do with your preferred shares. So these guys are telling us that the common shares were 4 million shares. Okay. When we are calculating VASO, we are only looking at the number of shares. The whole idea with VASO is at any given point in time, how many common shares were outstanding. Okay, so we are normalizing that. So if we look at this example, they said the total shares are $4 million at the end, but then they throw this blurb there to say during 2020, the corporation's only share transaction was the issuance of 400,000 common shares on April the 1st. Okay, so we are on December 31st, which means if you look at it conceptually, there were different number of shares outstanding from January to March. And then in April, they brought over these 400,000 shares. So there are different total number of shares outstanding from April to December. So how do I normalize this to say, no matter what day of the year I look at, I should have a number of shares that were outstanding. That is what VASO is. It will normalize it. So far, does it make sense? Or does it only make sense to Kinshuk, Kevin, just two? All right,
Could
thank
you
you.
please repeat
Okay.
it? Sorry, could you please repeat it? It's really not clear to me.
So they are saying that at the end of the year on December 31st, 2020, these guys had 4 million common shares outstanding. So that is on December 31st, 2020. But then they throw this blurb in to say that out of this 4 million, actually 4 million is the total on December 31st. Okay. So actually, during the year, they did new issuance of common shares for 400,000. So that means if I look at it, you know, I'm looking at the whole year from January to December. So January to March, I had different number of shares that were outstanding. In April, they brought over these 400,000 additional shares. That means from April to December, I have different number of shares outstanding. And on December 31st, I have a total of 4 million shares outstanding. So I'm looking to normalize this data to say, no matter which day I pick, whether it's December the 1st, July the 2nd, or November the 30th, or December the 31st, doesn't matter. In that year, whichever day I pick up, I want to have a normalized number of shares that were outstanding throughout the year. So that is what our VASO is going to give us. Okay, so in order to calculate that, what I do is I say, okay, so there are two tranches here. One is the tranche between January to December, so the first day of the year and the last day of the year. But before I get to that, in this case, we know on April the 1st, this company brought over 400,000 shares. Now these 400,000 shares, so if you look at that from April to December is what? 3 quarters, 3 out of 4 quarters. Okay, so all I did was 9 months, which is April to December, divide that by our calendar year. So these shares were actually outstanding in the market for 0.75% time. If 1 is my year, then out of that year, only 3 quarters of the time, these guys were outstanding. So when I multiply these two numbers, 400,000, with the prorated number of 0.75, then I get the weighted average shares outstanding of 300,000. Now I know the total number of shares outstanding were 4 million, which means on January or between January and March, I only had 3.6 million shares outstanding. Okay, but these 3.6 million shares, technically, if you look at it from a very logical perspective, these guys were then outstanding from January up until December, right? So they were outstanding for 12 months out of 12 months. So they were outstanding for the whole year. So 3.6 million times 1 gives you 3.6 million. So our total number of shares that were outstanding during the year is $3.9 million. 3.9 million shares, not dollars. So if I pick any day in the year, okay, whether that is January the 2nd or November the 30th or July, whichever day in that January to December period, at any given point in time, the normalized number of shares that were outstanding is 3.9 million. Now that 3.9 million is what we are going to use for our VASO calculation. So for our income from continuing operation, we know that our income was 16,555,000 minus our preferred share dividend, which is 1,075,000. Divide that by our weighted average shares outstanding, which is 3.9 million. So that gives us earnings per share of $3.97 from our continuing operations. If we follow the same logic for our discontinued operations, so the discontinued operations income or the loss in our case, it's a loss, so it will be a negative number. So the loss is 2,257,500. The preferred share dividends has nothing to do. We only account for that once in the operating section and then we are done. We divide that by the total number of shares outstanding, the common shares of 3.9 million. That means we ended up losing 58 cents on every common share that is outstanding because of the discontinued operation. Either we can take the difference or the additions or of your net income here, or you can go 14,297,500 minus your $1,075,000 of preferred share dividend divided by 3.9 million shares. You will still get 3.39. Or in this case, I have just taken positive 397 minus negative 0.58 gives me the difference of 337.
I have a question.
Mhm.
The income from continuing operations, shouldn't the net income amount that you used be the 1,429,700 rather than the 16 million number?
No, because that is here. The 14 million will get used here.
Okay.
Right? Because the 14 million is made up of the continuing and the discontinued. So we are showing EPS for each of this piece. Does that make sense?
Yeah, thank you.
No worries.
Could you please explain one more time why we did not subtract this number of preferred dividends for
From
the
the discontinued?
discontinued? Yeah.
Because it only needs to be accounted for once. Because the preferred shareholders are also your shareholders, but they don't really get a voice. They don't have a voting right, right? They have nothing to do with your discontinued operations. It's not hinging on them. They have got no relations to it. Other way to look at it is you only need to account for the dividend once. The preferred share dividend is only accounted for once in this calculations. If we did it multiple times, then it will be double dipping. Any other questions?
That means, oops, and that means it's not going to be calculated for net income too, right?
No, no, it is. Right? Once. So let's say if I said this minus this divided by this, 3.39. It's the same as that. How do I get rid of? Sorry, guys, I'm having a bit of a time with the, there. I know it's a great tool, but I'm not very big on the Google Sheets. That's why. So this 3.39. Okay, you know what? I'm just actually going to. Okay, it won't let me do that because it's a formula. Okay, let me show you where that is coming from. So it actually is 14,297,000. If I type something wrong, let me know. 1,075,000 divided that by 3,900,000. I think I got that. 14,297,500. Yep. Okay, so you have to account for the dividend once. So this number was a combination of these two where the dividend is accounted for once, or you can directly do it in net income. Either way, you will end up with the same result. Good then?
Question here. So it means we need to subtract preferred shares dividend just once in either if it were if there was profit, let's say for example from discontinued operations, we don't need to subtract the preferred shares dividend because we have already subtract from the earning per share from income from continued operation. That's what you are saying?
Well, the preferred share dividends are only related to ongoing operations. They will never be adjusted on discontinued operations. Never. Okay. They are only adjusted here. So we will only account for them once. But keep in mind, guys, in the example that I gave you, my real life example, in that my discontinued operations had a gain. If it is a gain, then your total net income, this number will go up. So stick to the logic, don't try to memorize these things because it's not going to go well. If I change one variable and you were trying to memorize, then you would have no idea what to do with it. Okay, so try to look at the logic. Because it was a loss, that's why your net income EPS number is going down. If it was a gain on my discontinued operation, then this number will go up. I mean, that's given, right? We don't have to state everything. Some of these things are just given. Stick to the logic. Are we good?
Okay. So now I'm saying, let's say if the income from continued operation was loss, but we gain from discontinued operations. And if we pay dividend for preferred shares, we can subtract from the second one.
Then you would add it, and that's actually a good question. So if you actually have a loss from operations, okay, let's say your loss was $100,000. I'm just throwing a number, okay? And your preferred share dividend is still the same, which is 1,075,000, then that means your loss is a bigger loss. This actually is a very good question. And I'm going to leave it. Do you want me to leave it on that sheet or? Okay, because you have to, the idea is that preferred shareholders needs to be given this money. So whether we have a loss, if we have revenue, then it will be the lesser of a revenue. If we have a loss, then we still have to pay them. So your loss is going to be a bigger loss. Okay, so it will change. Yes, the dynamics will change. And then if you had gain here, so let me calculate the number. This is an assumption so that nobody gets confused here. So these are all the assumptions here. There. Okay, so gain. So day gain on discontinued operations. So do you want me to use the same number or a different number? But here I'm not going to have any calculations, okay? So don't try to look for the links. I'm just throwing some numbers. So let's say I had a gain of $150,000. I'm just assuming it, okay? I just had to have a gain. So I got a gain, that's all. But look at it conceptually. So if I had a loss of, how would I make this work? Can I? No, I'm going to have a negative $100,000 of loss plus the preferred shares dividend divided by the total number of shares outstanding. And why is that not working out? So that is an error. And why is that an error?
Because you didn't put an equal sign before you start typing it, I guess.
No, if I put the plus or minus, it is equally good. I should be able to do that. But maybe it's these commas that are causing the issue. Let's try to. Is that what it is? There. So it's the commas. It doesn't like the commas because the commas usually are just for the, and here we had a gain. So I'm going to keep it a positive number. Divide, Guru, 3.9 million. Oh, no comma. 3.9 million. And this one, we just want 2 decimal places. Oh, come on. How do I make this thing work? Why is it not working? How do I do the format painter? Sorry, guys, it's just... I know it worked earlier. I can't make it work now. Okay. Yeah. Oh, because it's 3.8. So that's what it is. So sum of these 2 items, I lost 0.21.
Okay.
Does that make sense?
Yeah.
Sorry, but you did subtract the 100, the loss of 100.
Yep.
But this is a loss. They should be both negative, right?
No, this one is gain, right? We changed this one to gain. If they were both lost, then they will both be negative. So that's what I'm saying, guys. Stick to the logic.
The one
Here,
that, the one that is above, the loss from operations. Can you
yes.
just double click here at the formula? Yeah.
Well, this is not the formula. This is just the numbers, right? So if it's a loss, so I just made that a negative here. This is just mathematical calculation, guys. So whichever way it makes sense to you, if you want to calculate that as an absolute number and then change it to a negative, and that's what I've done here. I've shown you the absolute numbers. And you know what? Maybe I should take this out. Maybe that will help. It's how you make sense of your information. I usually, when I look at the brackets, to me, that means that it's a negative thing. But if I'm calling this a loss, then all I got to make sure that this number is a negative one. Okay. Otherwise, if I don't give you the formulas and you try to punch them to calculate the numbers, then you will get a weird answer, because without the formulas, your Excel will read this as a different. Okay, it's just how it works through the brackets and stuff. So it's just the kinks of working through Excel, and it's just mathematics. It's not me, really.
In your calculation for loss from operations, you did not make the 100,000 negative. You left that one as positive.
No, I did make it negative here.
Where?
This is 100,000 minus that 1 million. Oh, I see what you're saying. Ah, I
That's
see what
what
you're
I was
saying.
talking about. Okay.
Oh, you were talking about that? Okay, so
Yeah.
then it could have been me. Okay, sorry. Let me go back to that. And you actually would be right. Darn, I just don't know how to make these darn Google thingies work. Would that work? There.
Yeah, that's correct.
That's the right one? Okay, thank you. Sorry, I misunderstood. You're right, I wasn't adjusting at that time.
Okay, thanks.
All right. And those are great questions, you know, and this is where the live sessions are really so much fun, because, you know, different people have got different questions and different ideas. It's always nice to explore and see what it looks like. But yes, this could very well happen. Nothing wrong with it. So when you're looking at your information, always try to look at it from a very conceptual standpoint to see how, why, when, where. Mikiko, did you have a question?
Yes. So just because my understanding was maybe wrong before or for the prerequisite, so even that the loss on from the operation was lost, and then still the preferred shareholder is gonna get, or is it usually when it's declared, it's gonna become like a cumulative, like in dividend in arrears, and then once the operation getting the gain in trust, and then the time that they're going to receive the cumulative dividend in the preferred?
Well, and I wouldn't say that your understanding was wrong. I would just probably say that it likely is not wholesome. So the way you're right, the dividend has to be declared before it can be paid. But when it comes to EPS calculation, when we adjust for this $1,075,000, guys, and that's again is a great point, because, you know, these guys might not have gotten that money paid. Okay, but EPS calculation will always boot out the preferred share, guys. It always will be. Okay, there are more nitty-gritties to this subject, but unfortunately it doesn't get covered in this course. Say it doesn't cover it, I do cover it at other institutions. So there are some more nitty-gritties, but yeah, that's what that is. But you're right, they really don't get paid this. The payment of the dividend is really different than the EPS calculation. So don't try to look at them together. Then you will get confused, because what you're saying is right and what I'm saying is right as well. It's just that they're two different things.
Oh, okay, just to
Yeah.
recording it.
Yeah, because with this calculation, the preferred share dividend will be booted out every single year. Yeah, because they just want to know, you know, because these are the common shareholders are the actual owners of the business, and they want to know how much money each common share made. And this actually indirectly drives the share prices as well. So different takes, different ideas.
Okay.
All righty.
Okay.
Okay, then we will move to E4-15. All right, so here we are talking about adjustments to our retained earnings for the prior period. Okay, so Eddie Zambrano's Corporation, a private company, began operations on January the 1st, 2017. During the first 3 years of operation, Zambrano reported net income and declared dividend as follows. So they have given us net income and dividends for all of these years. The following information is for 2020. Income before income tax is $240,000. Now they are giving us correction for prior period error which is understatement of 2018 depreciation expense, is $25,000. Cumulative increase in prior year's income from changes in inventory method before tax was $35,000. Dividend declared of this amount, $25,000, will be paid on January 15, 2020 is $100,000, and the effective tax rate is 40%. We are preparing a 2020 statement of retained earnings for Eddie Zambrano's Corporation. The company follows ASPE. So if the company is following ASPE, my friends, we will be using a statement of retained earnings. Now, statement of retained earnings, it's one of the easiest one to make if you don't have any prior period adjustments. Okay, so basically this is your beginning retained earnings plus your net income minus your dividend, and that gives you your ending retained earnings, and life is wonderful. Okay, but in this case, these guys have prior period adjustments. So the learning here is, how do we account for prior period adjustment? So in accounting world, if there is any adjustment for the prior period, then those adjustments have to, any adjustments that affect your retained earnings will have to be net of tax. That means after tax. Can anyone tell me why? Yeah, that is because if you think of your financial statements and how the information is flowing from one to the other, so we prepare our income statement. Remember the net income number that flows to equity section or the retained earnings is after tax, right? Let me come back. Net income, no, not this one, this guy. This was a better example. When we take the net income and this net income flows to your retained earnings, and then the retained earnings numbers flow to your statement of financial position or balance sheet. Remember, the tax is already adjusted, so this guy is always after tax. Okay, that means anything that goes in the retained earnings account is always after tax. Okay, so now if we need to adjust for the prior period errors, then we need to make sure that the prior period errors are adjusted net of tax as well. So what we are going to do is we are going to start by this time, guys. At this point in time, you guys understand that every financial statement needs to have a title. Whether or not mention that, it's there in the solution, it's given. This is the very basics. Okay, so if I don't mention it, doesn't mean that it's not important. It just means that it's given. Okay, you have to do it. So our beginning balance for the retained earnings is $225,000. That was given to us. Now, what do we do with that information? Any ideas?
We have to adjust it for the corrections.
We have to adjust it for the corrections. Awesome. So let's start there. So we know that our before tax adjustments, not doing anything other than just bringing the data to my Excel. Okay. So we have two types of adjustment. One is understated 2018 depreciation expense. The other one is a cumulative increase in prior year's income. Okay. So cumulative increase will increase the income. And understatement of expense means that in the prior year, our expense was lower than what it should have been. If the expense was lower, that means the net income number would have been higher that got pushed to retained earnings. So we need to bring that guy down. Okay. With the errors, my friends, when it comes to errors, always follow the logical flow of what's happening and why, because it depends on the error and what really happened, which will dictate whether it will increase or decrease. Okay, so depreciation expense was understated in prior years. If your expense is lower than what it should be, let's say it should have been $100. We only recorded it for $80. That means now your net income is overstated by $20, and that overstatement hit your retained earnings. So your retained earnings is overstated. Are you with me so far?
Yes.
Yeah, okay, good. Okay, so the same logic applies here. So this Depreciation expense was understated there. That means retained earnings is already overstated this 225,000 and we need to bring this guy down. Now, the only problem is that your retained earnings is always after tax. Always, always. It's such a basic thing. Okay, but it's a great thing to remember. Always after tax. So if before tax was $25,000 and my tax rate is 40%, then I can easily, for both of these transactions, calculate my tax impact. So 25,000 times 40% gives me tax of $10,000. And on our inventory change cumulative adjustment, if my total before tax is 35,000, 40% tax gives me $14,000. So my net of tax will be 25,000 minus 10,000 for the depreciation for the depreciation adjustment. And for the cumulative increase in the prior year, it's 35,000 minus the tax, which gives me 21,000. Now, before we go on to anything, we said the retained earnings is fairly simple. So beginning retained earnings plus income minus dividend gives us ending retained earnings. Before we get on to that, your beginning retained earnings has to be restated. Okay, so this one we said was going to decrease our retained earnings by 15,000 because it was overstated in the prior period. So in order for us to undo it, we have to do exact opposite. And this one is an increase of 21,000. So all I've done is I've just brought that information forward once it's calculated. All right. Then dividend piece was given to us. There were two types of dividends that were stated. For the common shares, no, sorry, there is only one amount of dividend, which is $100,000. Okay, so that $100,000 is given to us. And net income, the income before tax is $240,000. What are you going to do with that?
Calculate the
Apply
tax
tax to
and
it.
Sorry, add tax to it?
no,
Yeah.
subtract the tax amount.
Subtract the tax from it. Perfect. Okay, so our net income, which is net of tax, is $240,000 that was given to us. And I have only taken the 60% of that because the other 40% would have been tax that was calculated on income statement. They just didn't tell us. So that's what that is. The dividend declared was given and our ending balance is $275,000.
Sorry, but why did we subtract the tax? That amount 240 is before tax already.
Yeah. So if you think of this guy, so it's before tax, this guy, if this was your 240,000, oops, that's what they're telling you. So what will this be? Because this is the number that's going to your retained earnings, right?
Yeah.
Make sense?
Yeah,
Okay, so
yeah.
sometimes it just makes sense to have it conceptually. So nothing wrong with that.
Yeah, thank you.
All right. So the whole idea with this is with the 4-15 is we need to make sure that the adjustments are done before to our beginning retained earnings.
I have a question here.
Go for it.
The Excel side.
The Excel? Excel?
Yeah. What's this cumulative increase in prior years income from changing inventory method? Why do we add this?
Well, because that's an increase in the prior year's income. They told us the effect already, so it's increasing. The question already gave us that information.
Well, first, is it proper to change inventory method?
I'm sorry, I can barely hear you.
Yeah, I mean, why they changed the inventory method for in prior years?
Well, see, all of these concepts are actually a discussion in itself. So we are not talking about why they changed it. What we are talking about is if they changed it, how are we going to account for that? Because these are two different conversations entirely, and that's a very valid question, but it's not the one that we are covering here.
Okay.
Because prior period adjustments are quite a thing actually.
Okay.
Mm-hmm. All right, so moving into E4-16, and that's the last one we are looking at today, right here.
Just one quick question. Where did you get the starting balance of 225,000?
On this question,
Yeah, on
the
the last
earlier one?
question, sorry.
Okay.
Yeah, I don't see it anywhere, so am I missing something?
Okay, does anyone know where this 225 is coming from?
That's the sum of the net income from 2017 to 2019 minus the sum of the dividend declared during that time.
Okay, so that income minus the dividend declared, is that what it is?
Yeah.
Okay, let's see. So the income was what, $40,000? So 4125.60.
Oh no.
Minus 100.
And so this was the income and the dividend. So the dividend was 0 in this case.
50 and 50.
50 and 50.
And yeah, it's correct.
Is that what it is?
It was
But the last
160,
one is
not
160.
160, not
Oh,
60.
this one is 160? Okay.
Yeah.
So the total income is that, and the total dividend is that. Does that make sense, Kevin?
Yes, I get it now. Sorry, thanks.
No problem. And thank you for pointing that out because I was going to miss that piece. So, and sometimes, guys, we just leave these things out on purpose, okay, just to make sure that everybody is paying attention and, you know, that we are all engaged and we can think through that information. So sorry, who provided me with this information?
Me.
Makiko, thank you so much. Okay. And I'm seeing your question on the chat now, Kevin. Sorry about that. I think I'm still struggling with these Google Sheets. But is this tool actually working out for you guys, or you're indifferent, you don't care? So do you prefer this, or do you prefer what we did last time, or?
Well, will we be able to see this too, like from home?
Well, right now, if you have clicked on that link, then you should be able to. So I would recommend you go ahead and download your files, because once I close that, then you won't see it. Then you will only see the one that is there on the D2L, but I'll make sure to update this on the D2L as well.
Okay, so you will upload it to the D2L.
Yeah, the one that didn't have this explanation, I'll go ahead and do that on the D2L for sure. Okay.
Okay, so it's going to be in the same like we used to have like Excel spreadsheet
Yep.
in class problems. Yeah.
Oh,
Okay.
yeah. The same place. I'll just take off the old version and I'll put the new version.
Okay, thank you.
Yeah, no worries, no worries. Okay, so the last one we are looking at is P4-16. So Rainy Day Umbrella Corporation had the following balances at December 31st, 2019. All amounts in thousand, preferred shares, common shares, contributed surplus, retained earnings, accumulated OCI, income, everything is given to us. Then they have given us a bunch of transactions that are happening during the year. Now, in this case, we are preparing a statement of changes in equity for the year ended December 31st, 2020, as well as the shareholders' equity section of Rainy Day Umbrella Corporation statement of financial statement or financial position as at December 31st, 2020. Gains or losses on FVOCI investments are not recycled through net income. Now, this actually is a concept that we will cover in the last class when we talk about investments, so don't worry about this just yet. But in this case, we are preparing our statement of changes in equity. And this is what your statement of changes in equity looks like. Okay, now the title to your financial statement, the columns for your preferred shares, common shares, they always come in that sequence. And then the contributed surplus, retained earnings, AOCI, and a total. Okay. So we started with the beginning balances, so nothing fancy. All we did is just brought over the numbers and then I threw a total for that. Okay, now the format for your changes in equity is fairly liquid. It really depends on what else is happening in that transaction. Okay, what kind of transactions did the company go through in that time period? So in this case, they had the net income, and we are looking at here, guys. So during the year, they ended with, the company had net income of 7,320,000. Now in this case, if you pay attention to this one, the first set of numbers, okay, they sneakingly told you here that all the amounts are in thousand. That means they dropped 3 zeros on these numbers. But the second set of information, they provided you with all of the numbers. That's why they made a new paragraph. Okay, so entirely two different things. So either you need to convert your beginning balances and add those zeros, or you got to drop it here. All right, your thousands. So that's why when you're preparing your financial, and these minor details is what will make a huge difference. So here, I just dropped all the zeros and said all amounts are in thousands. Okay, that's why my beginning numbers are actually in line with the numbers that they stated. But if you look at my net income is 7,320,000. The net income will increase your retained earnings. The dividends will reduce your retained earnings. The gain in AOCI has been added. And in this period, the company issued more shares of $285,000 actually, but we have everything represented in thousands, so I just went 285. If the company had retired shares, then this number will become negative. Okay, so the layout of this particular financial statement is very logical, and it really depends on the type of transactions the business went through in that time period. Questions? Because this is all we have for chapter 3 and, sorry, not chapter 4, but topic 3 and 4.
So E4-15 and E4-16, both in both problems we had to make statements of changes in equity, except two of them have two different formats.
No.
Oh, one of them is statement of retained earnings.
There you go. Okay. Yes. Okay. There you answered yourself. So this one is ASPE, and this one is IFRS. Yeah. Okay. So Kinshuk was asking about E4-15, that 225 has to be net of tax. Anything that hits your retained earnings, guys, it has to be net of tax. Okay. Any other questions about anything that we talked about today? And, you know, make sure to find the time to practice more and more of these examples, because, you know, accounting unfortunately is not a spectator sport. You can't get better at just by seeing somebody else do it. So make sure to find the time to practice these, because otherwise it's going to be really hard on the exam. Questions? Anything?
Do you have like suggestions of which problems to practice?
I would say pick the ones that are similar to the ones that we do in class. I really don't go through them to hand pick. Yeah, I've tried doing that in the past, but I've recognized that at some point in time, you know, not everybody is happy with what's provided. So I've stopped doing it. So yeah, the examples that represents our learning objectives should be a good one. But if you look at your Wiley Plus should also be a good tool. Okay, talking about the Wiley Plus, make sure that you guys are actually doing your assignments as you go. Not a good idea to keep them till the last minute, just because, you know, right now the concepts are more fresh in the mind, so it's easier to get through them rather than wait at the end and then just get overwhelmed about that. And once again, guys, once the assignments close, they close. No matter what the reasoning is, they will not be opened. Okay, so don't take that chance and don't keep it till the last minute. It's just not worth it. You guys pay decent monies for your courses. Just do justice to that. Be nice to yourself.
Well, in your PowerPoint, you were talking about that OCI, other comprehensive income. It wasn't very much explored in this practice, but can you explain a little bit? It's a little bit confusing. Oh, no, I mean, I don't really know the example of this.
Well, we haven't covered the example, and there's a reason why we haven't covered that, because there is a different section for that, and we will explore that as we go through the courses. But at this point in time, I just want you to understand that, yes, the OCI does come into play as well. So hold it at the back of your hand, but we will talk more about those. So there are, you know, in the first couple of weeks of these classes, we are going to keep introducing new concepts, but not really explore them in details, but we will do that as we go.
Okay, thank you.
No worries. Anything else, lovelies?
No, all good. Thank you.
All good? Okay. It's really nice to have all of you guys come online. It's always nice to have the live audience, and, you know, the learning and the discussion always helps. It makes it more engaging, because otherwise just, you know, I love myself, but still talking to myself is not a very fascinating idea. So I don't look forward to that. So I really appreciate all of you guys coming online. So thank you so much for that. Do make sure to keep listening to those videos. Now for you guys, I have tried to keep ahead of the curve. I actually took a couple of days off and recorded a bunch of videos for you guys, and I've posted all of them that I've recorded, but I have missed a couple of topics in between. So I'm working on that. Those one will soon come. But yes, everything that you need for the next 3-4 weeks is already up there and more. Okay, so keep up with that. All right, and find the time to practice. But if you don't have any other questions, then I'm going to see you guys next class.
So for next class, we need to watch the video for topic 5 and 6, or just 5?
Follow the class schedule. Whatever I have listed on this class schedule is what we are going to follow. So that will be topic 5, which is on statement of financial position. All right. Now with that one, now keep in mind, guys, technically the idea of these classes, or the synchronous and asynchronous mixing, was that these classes will be short. But if you guys notice, in the last week and this week, we practically have gone through the same in-class length time over and above the videos. Okay, so please, let's not feel that anyone is getting chump changed here. If anything, we are getting more value than what the in-class sections do get. Okay, so yeah, okay, just because we are home doesn't mean anyone is getting chump changed. Are we good?
I have a question about the schedule. You said, I think, the chapters, we are not following the textbook sequence of the chapters. So we have to see the topic on this Excel and the YouTube video, or where can we follow the topic? Yeah, the chapters of the topic that we are studying right now.
So everything that you need is, so if you go on to your D2L, so
Okay.
under the D2L, and I actually went through this with and it's there in the recorded section as well, guys. So we got to be really careful, because more we keep repeating the information, the longer the time is going to be. We want to spend our time together more productively than going over the same concern, okay? I don't mind them, but it has to be the best use of everyone's time. All right, so we did go through this in our first class. It is part of the recording section. So once you log into your D2L, under the D2L on the left hand side, you will see Guru's Corner. That's my name, so my corner. Under that corner, you have different sections where you will see the PowerPoints, you will see the video lessons that are posted, you will see all of the Excels posted right from the first topic up until the last one. So I have made plenty of material available for you guys already there. So please go there and take the time to explore that. Your course schedule is there as well, and that is what we will be following. Does that work?
Yeah.
Mm-hmm.
Yes. Okay. Now I
Any other questions, or can we call it a night?
Good night.
Good night, guys. So if we don't have any other questions, I'm going to stop the recording here and